You can up with 50,000, 100,000 gold price targets. Yeah, I mean we can play around those numbers, but from my point of view, the essential point is if we're going back to some sort of a re-monetization of gold, then it's still, I think, pretty cheap. Gold was really contrarian. Nobody liked gold. We said that our target, our base case scenario for gold at the end of this golden decade is $4,800. People said, you guys are crazy, it's never going to happen. But then we also said there's an inflationary scenario. So if inflation will be a concern in this decade, if it will be a topic in this decade, then our price target is $8,900. So we already exceeded our base case scenario in 2026.
Gold price forecasts are being redefined as re-monetization debates intensify. In a discussion highlighted by David Lin, renowned precious metals analyst Ronald-Peter Stoeferle argues that gold remains fundamentally cheap if the global system moves back toward monetary gold. While extreme targets of $50,000 or even $100,000 per ounce are discussed, Stoeferle's original base case scenario of $4,800 was once considered radical and has already been exceeded by 2026. His inflationary scenario projected gold at $8,900, reflecting rising concerns over long-term inflation. With gold once deeply contrarian and unloved, the current golden decade narrative is reshaping investor expectations. Now, we present the clips from Ronald-Peter Stoeferle's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Everything is just happening so quickly, and Donald Trump is now in office for just 1 year. We've got 3 more years. And I mean, what's going to happen in the next 3 years? I don't know. But in 2020, in Gold We Trust Report 2020, we said we're expecting a golden decade. Back then, gold was really contrarian. Nobody liked gold. We said that our target, our base case scenario for gold at the end of this golden decade is $4,800. People said, you guys are crazy, it's never going to happen. But then we also said there's an inflationary scenario. So if inflation will be a concern in this decade, if it will be a topic in this decade, then our price target is $8,900. So we already exceeded our base case scenario in 2026. And we're right on track for this inflationary scenario target, which is 8,900 at the end of this decade. Now, 8,900 still sounds extremely bullish, but that's a CAGR of 12.3%, which is pretty realistic.
By the end of the decade.
By the end of this decade, yeah. So we kind of stick to that target, and the big call in our last In Gold We Trust report that came out in May last year was called the Big Long, and the thesis was now is the time to be overweight silver and mining equities, because until then actually silver has underperformed gold, mining equities have underperformed. So we said like in cycling, silver and mining stocks will come out of the draft and really show big momentum, and I think that people completely underestimate when momentum really kicks in, how dynamic it actually is, And we've seen this dynamic in silver. I remember trading around 30 for ages, and then we took the 50 and then off to the races, Mining stocks developed tremendously over the last couple of weeks. And I think that the risk reward for silver is still a good one. I think for commodities, for mining equities, we're still finding some bargains. We're still seeing like attractive valuations in some of the large cap names, even more so in the junior space. But I'm seeing the most attractive risk reward now in the commodity space. I think that's really, from a cycle point of view, I think commodities are next. Pretty obvious to me that we've seen the lows and that we're gonna move into a big bull market again, So I think back then inflation was really, asset allocators in the Western world, they're like, they're so accustomed to inflation being the least concern for portfolio construction. We can call it de-dollarization. We can call it basically emerging market countries actually now just want to be treated in a fair way. They want to be respected. This is where the growth is, where the savings rates are higher, and this is where the gold actually goes. Yeah. So if we're really questioning this paradigm that perhaps U.S. Treasuries aren't risk-free, I think this is still, if you're going to a CFA conference, this is still very, very controversial. For me, being a student of monetary history, being a student of cycles, it's not something controversial. And from my point of view, the US is still on a relative basis more attractive than Europe, unfortunately.
Gold's rapid ascent is reinforcing long-term bullish forecasts first outlined in the 2020 In Gold We Trust report. Analysts behind the report argued for a golden decade when gold was deeply contrarian, setting a base case target of $4,800 and an inflationary scenario of $8,900 by decade's end. That base case has already been exceeded by 2026, keeping the inflation-driven outlook firmly on track. The latest thesis, The Big Long, emphasizes silver, mining equities, and commodities as momentum builds. With de-dollarization, shifting global capital flows, and undervalued miners, the commodity cycle appears to be entering a powerful new bull phase. Let's get back to the interview.
And I think that, this kind of a sober view on gold is something that is totally missing. And this is why we put out, big reports like the In Gold We Trust, just crunching the numbers and saying, a certain allocation of gold totally makes sense from a portfolio point of view. Mm-hmm. Let's say like 10 to 15% really improves your portfolio characteristics. And we came out with this so-called new 60-40 portfolio, where we said, okay, let's say 15% physical gold as a strategic monetary insurance, but also 10% what we call performance gold. And this is gold and silver mining equities, for example. Then we said 10% commodities and 5% Bitcoin. So there's definitely a larger allocation compared to the traditional 60-40 portfolio to hard assets. And I think that now more and more people are kind of waking up and see, well, inflation is kind of sticky. We're still above 2%. Still, central banks, have already lowered interest rates. Perhaps the next inflation wave is around the corner. And I think if that should happen, if we're actually at the beginning of the next inflation wave, then I think we'll see more and more flows coming from, traditional investors. But our job again is to make a sober case for gold, and I think, the numbers speak for themselves. Gold has a CAGR of 9.4% since 1971. So gold is a fantastic portfolio diversifier, and really my mission is to get the emotions out, just show the numbers, create a strong case for gold, a strong, sober case for gold. I think that's kind of missing in our industry, unfortunately. I read up about that, the 1970s gold bull market, and we had a nasty 50% correction from 1974 till 1976. But then at the very end, the majority of the demand was actually coming from fixed income investors. And there's some stories of bond fund managers. They had up to 30% physical gold in their bond funds. Now, currently, this is, I think, from a legal point of view, it wouldn't even be possible. But this, I think there's a strong analogy that there's shifts coming from, or that the majority of the future demand might come from fixed income. And as I've said before, that's still a huge asset class. And the big question is, and if you're having a look at the news, I think that the US is slowly becoming more of a low trust society. And if there's eroding trust in the US, in the US dollar, in US treasuries, I think the other side of that trade is obviously gold. And gold has built up this enormous amount of trust capital over the last hundreds and thousands of years. And if that's really continuing, this loss of trust, then again, we're probably not very early, but we're definitely not at the end of this bull market.
A sober, data-driven case for gold is gaining traction as investors reassess traditional portfolios. Analysts behind the In Gold We Trust report argue that a 10-15% allocation to gold significantly improves portfolio performance. Their new 60-40 portfolio replaces paper assets with hard assets, 15% physical gold, 10% gold and silver mining equities, 10% commodities, and 5% Bitcoin. With inflation remaining sticky above 2% and central banks easing policy, gold's role as monetary insurance is resurfacing. Since 1971, gold has delivered a 9.4% CAGR, reinforcing its status as a trusted diversifier amid declining confidence in U.S. Treasuries and fiat currency. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.